What's up, everybody? It's the Digital World Podcast, and I'm going to go a little more into detail about what the reverse repo market is telling us. And this time, I'm going to allow George Gammon to explain it more concisely and in depth so that you can get a better understanding of what's actually going on. So, I want to clarify from yesterday's video and kind of make you aware of the situation and how everything is being put into plan, into action. And it makes you wonder about the coming financial crisis. If everything has been essentially merged into one balance sheet, what that may entail. Okay? Now, take a listen to the explanation that George Gammon gives.
View how this reverse repo works. We've got the Fed here, bank here. Balance sheet of the Fed starts with a treasury and a deposit, the bank reserves for bank, we'll call it XYZ ABC. What happens in a reverse repo is the bank agrees to lend the Fed money, and then the Fed, for collateral, gives the bank the treasuries, and the next day, the next 2 weeks, the next 30 days, they just go ahead and swap. But technically, it is a purchase. The bank is buying the treasuries from the Fed. And when the Fed buys the treasuries back, they're buying them at a slightly higher price. So that's kind of the interest rate, if you will, for borrowing the money if you're looking at it from the position of the Fed. Going back to step number 2, what we realized is if the bank is going to give the Fed money, just like Moody paid off their loan, or the average Joe bought the treasury from the bank who had their money as an electronic liability in the first place, the balance sheet of the entity that received the payment would actually shrink. It would not increase because they're not taking additional money. They're just deleting a certain amount of money that was owed to the person that paid them in the first place. So after the reverse repo transaction, if this was not a smoke and mirror scheme, what would happen is the Fed's balance sheet would not have a treasury or a deposit. The deposit would be deleted, assuming that they had the exact same amount of money in their account that they were buying the treasury for. And then the treasury would go from the asset side of the Fed's balance sheet to the asset side of the bank's balance sheet. This is how it should happen. But what I'm going to reveal right now is this is not the way it's happening. For more on that, let's go right to the internet. Let's start by going straight to the New York Fed's website, where they describe the process of the reverse repo transaction. When the desk, which is their trading desk, conducts reverse repo.
And so he goes over essentially what he just described earlier, okay, on how the Fed and the banks are essentially swapping. It's a purchase, but they swap. Now, I'm going to go ahead and skip over here to the part where he starts explaining again the situation of them combining the balance sheets. And when they combine the balance sheet, we see that it creates one huge balance sheet.
Website was saying right here on the whiteboard. When we start with the treasury and the deposit or the bank reserves as an asset and liability of the Fed, and those bank reserves as an asset of the banking system, after the reverse repo has been done, the balance sheets are identical. The treasury is still an asset of the Fed. The bank reserves are still a liability of the Fed and an asset of the commercial bank. But what has happened is the bank takes the treasury and basically pretends that it's on its balance sheet and that it owns it legally. And then they sell it into the treasury market. Let's just say they're selling it to sell it short because they think interest rates are going up, therefore prices of bonds, treasuries, are going down. Then what happens is a financial institution buys the treasury that the bank just sold. So let's think this through. After this entire process is done, the financial institution would have the treasury as an asset on their balance sheet. But so would the Fed. And the deposits, the bank reserves that the bank had originally are still there as an asset on their balance sheet and a liability of the Fed. So what is this telling us? Well, let's take one more step. If you combine the balance sheets of all three entities involved, what does it look like? You've got one treasury and one bank reserve deposit. The exact same thing that we had to begin with. So the big idea, the main takeaway that I'm trying to communicate to you is that what has effectively happened, what this reverse repo market warning sign has shown us, is that there's really only one balance sheet in the financial system. They've merged everything. It's central control or central planning on steroids. It's basically one balance sheet, and it's just used by whatever entity needs the assets or the liabilities in order to kick the can down the road and keep the music playing in this musical game of financial and economic chairs that eventually has got to come to an end.
Now, he perfectly lays out the situation and the issue that's happening. Now, if you have one balance sheet, that means that every single bank or every single financial institution is basically dependent on the central planners. And when this game comes to an end, they're all going to be dependent on them. It's going to be a massive, massive economic crash. And when that happens, they're going to have to rely on a new or a solution. And what may that solution be? What would help in a liquidity crisis? Well, none other than the lender of last resort to inject liquidity into the system. And this is something we talk about on the channel. And this is why I am invested in XRP, because it creates the solution to the problem that's coming. And when we talk about CBDCs, we know that the XRP ledger has been creating a private ledger for central banks for them to create their CBDCs. And that's why this investment makes so much sense in terms of what we see happening. And this is why I come in every single day and talk about it, because it makes so much sense for everything that's happening. And make no mistake about it, CBDCs are coming. They're here to stay. Now, here's an article by Zero Hedge. The worst kept secret in America, high inflation is back. Okay? And we know that the prices of everything are skyrocketing. We see that corn, soybeans, wheat have been trading at multi-year highs. Corn has been trading from $3.80 a bushel to $6.75. Chicken wings are at all-time highs. Copper, steel, lumber. We know what's been happening with lumber. Quadrupled in price. It's hard. It's really expensive. People have had to stop their house building process because commodities are getting way too expensive. We see gasoline, car prices, everything is going up. But people think it's it's just normal prices going up, and things just seem to be getting worse and worse and worse. But I guess we'll have to see. But we know that the Fed has said it's a transitory inflation, and that's we'll have to wait and see if that's the case. But yeah, inflation is becoming problematical, and it's here, and people are starting to notice because it's affecting their wallets. So we'll see where or how far this can is kicked down the road by the Fed and by these central planners. But the you know Piper has to pay the price at some point. And if you invest in what makes sense and what will uh, last through this turbulent time, then you should be fine. And I do believe that XRP creates a solution for the problems that are being created or that have been created. Hope this episode has brought you some value. Like and subscribe as always. I like hearing from you. Comment below. What are your thoughts? This is the Digital World Podcast, and I'll see you in the next episode.